All right, everyone, welcome to 1.2, where we're going to learn about securities and organization. So I made a funny little joke. Obviously, it wasn't funny, but last time I made a joke about securities. Does anyone remember what securities are within finance, or at least the realm of investment banking? Well, securities are investments. So whenever you hear the word security, think of it as a synonym to investment. And yeah, we're going to learn a lot about particular types of investments today. And we're also going to learn about the general organization of investment banks. So remember, investment banking is a function, and I have another video that's going to, relay that once again to you. We haven't really broken into the function of investment banking within investment banks yet. So remember, investment banks have a whole wide array of services, and we're going to talk about those services, or at least the one of investment banking, more in detail in Unit 2. Also, I want to talk a little bit about IBC Social. So we have one more presentation to this unit, and we have 5 units in total. So we have about 3 presentations per unit. And after next presentation, we're going to have something called IBC Social. And because we have 5 units, that means we have 5 IBC Socials. In each IBC Social, we have an investment banker come and talk with you guys. So the person that's registered for this IBC Social is a 3rd-year associate from the Royal Bank of Canada. And that should be really interesting, really informative. And if you don't know what an associate is, don't worry. I'm going to tackle that today. That's the organization section here. So you're going to understand how an investment bank works, essentially. And then as well, during IBC Socials, you're going to have games for monetary prizes. So that's going to be a lot of fun. You can win some money. And again, that's why we have the Google Classroom, so you can study up prior to that event. But let's just kick it off. If you can, scan this attendance sheet. Again, I'm not scrutinizing against anyone that didn't come. I just like to know how many people did come, so on and so forth. What? What? Oh, okay. And if you have any questions, you can always scan that attendance sheet again, and you'll note that there's a questions section in the bottom. So just let me know, because I'd love to answer them or research them with you. All right, and we're just going to get started. So again, remember, pay attention more to what I'm saying. You don't really have to read the board, because I'll make sure to break it down for you. I have a lot of text on there in the case some officer needs to reference it, so on and so forth. But okay, securities are investments, right? Investment banking quite literally has the word investment in it. So as you would assume, we deal with investments quite a lot, or at least for that capital raising service of investment banking that we talked about in 1.1. And capital raising is kind of a subsection of the service of investment banking. I know that sounds really confusing, but it'll make a lot more sense later. I promise. We have these small ideas and then we build upon them. So let's just get straight into it. A security is a fungible financial instrument that holds monetary value of some sort. Does anyone know what the word fungible means? Or fungibility? It simply means that it can be traded fairly, essentially. So let's say I have a $100 bill, right? And I need a change for that. Well, someone could give me 5 $20 bills. Cash is a fungible asset. Something that may be more non-fungible would be cars. If I have a Toyota and, well, I wanted something of equal value, I can't go to someone with another car and say, hey, give me your Lamborghini, right? Those two are of unequal value. You can't really trade them fairly. So that's what I mean by fungibility. And when it comes to that word financial instrument right over here, that just means an asset that can be traded. Cash is a financial instrument. Stocks are a financial instrument. Bonds are a financial instrument. They're all assets. They're all things that help you, not liabilities, and they can be traded. So now we're going to break into the types of securities, or those, types of investments. We first have equity securities. Does anyone know what that word equity means? So like if I were to say I have equity within my company, or equity within my home, what does that mean? Well, equity, it doesn't really have anything to do with equality, unfortunately. In fact, it may be more unequal, but it just means ownership. So if we're to think of 2 synonyms right now, securities are investments, and equity means ownership. A lot of the times when you guys buy your first house, or your parents bought their first house, one thing you may have heard them talk about a lot is getting equity within that home. That's why a lot of people choose mortgages over renting a place, because when you rent a place, you don't actually build ownership within that house. But when you get a mortgage, you are building ownership within the house with the downside of paying interest. So over time, you're probably paying more, but hey, you own that house in the long run, whether that be 15, 30 years, etc. That's what equity is. And a type of financial instrument within those equity securities are stocks. And we all kind of know what stocks are, especially David over here. But stocks grant you ownership within a company. That's why they're under equity right over here. And investment banks will raise money for respective companies. Remember, those entrepreneurs, not really entrepreneurs, but those companies with ideas that don't have capital currently, they'll raise money for them by helping them issue stock of some sort via usually what we call an initial public offering. So this is the first time a private company goes public. It's the reason why you can buy stocks on the New York Stock Exchange or NASDAQ. You can only buy them because those companies are now public and an investment bank has aided them in that. They have facilitated that. They're the middleman in that. So they'll help those companies by selling equity in the form of stocks. The owners of securities issued by an investment bank, generally through an IPO. All right, now we're going to talk about debt securities. So I'd assume that all of you guys know what debt means. Actually, I was in debt to one of our officers for $75 like 30 minutes ago, and I paid him off. So that's great. But debt just means that you owe someone, essentially. And when we get into debt financial instruments, we're usually talking about one of two things, either bonds or IOUs. What do you think IOU stands for, the acronym? It literally stands for IOU. Basically, even though that U isn't a Y, just think of it how it sounds, IOU. So bonds are IOUs. So people will lend money in the form of loans to investment banks with the respective return being that loan paid back with an interest rate. That, in a nutshell, is how a bond works. Does anyone know what the interest rate of a bond is usually called? It's called a coupon rate. So whenever you look at bonds, they're usually going to tell you, hey, this bond has a coupon rate of some sort. And if I'm to go in a little bit of a deeper tangent regarding bonds, well, can anyone tell me, do short-term bonds or long-term bonds usually have a higher interest rate? What do you think? Long-term bonds, yeah, right? Because you're giving, or at least you're allowing that company to use your money for a longer period of time prior to them having to pay it back. So you get a higher interest rate, but unfortunately, you get your money paid back slower. And time, again, is money. So investment banks will help companies by issuing the bonds, similar to how they issue stocks in that equity security scenario. And now, debt securities do not appropriate a portion of the companies to investors. All that means is you don't get ownership like you do with a stock. So when you invest in a bond, you don't get ownership of that company, unfortunately. However, if a company were to sell itself or go liquid for various reasons, debt security holders will have a higher claim to assets than equity security holders. You don't really need to know that. I'm going to draw a diagram in a second after we cover hybrid securities, just to give you an idea. If you're an individual investor, guys, this is going to be somewhat important to you because unfortunately, with every investment comes risk. There comes the risk that that company could liquidate. It could go bankrupt. Does anyone know what liquidate means? Essentially, yeah, to sell, right? Your company has basically failed. You may not be able to pay back your loans because your product isn't generating enough net revenue, or enough revenue. So you sell all of your assets to those that you owe in order to, well, recoup what you can, essentially. So when you go into bankruptcy, you kind of go into that process of liquidation as well. And it overall just means that your company's done for. And we're going to talk about what happens in a second. So if you're an individual investor and your company liquidates / goes bankrupt, what's going to happen to you? I'll get to that in a second again. So when we talk about hybrid securities, as you'd assume, right, like with a hybrid car, which combines both electric and gasoline, a hybrid security is, well, a security that combines aspects of both equity and debt. So an example of that would be preferred shares. So a preferred share is like a stock, right? You can call stocks shares. That's pretty common knowledge at this point. But like a stock, it would grant you somewhat of ownership within a company, but the way you get paid is where it becomes more interesting. You get paid dividends like a bond regularly. So it's like whenever you give a bond to someone, or whenever you buy a bond from someone, they have to pay you back over time with an interest rate. So with preferred shares, you're getting paid back over time, not with an interest rate, but with regular installments with dividends. Does anyone know what a dividend is? So whenever, you know it? Okay, what's a dividend?
Dividend is just like money that they give you, because you have a preferred share.
Yeah, and it's not just with preferred shares. You can get dividends with regular stocks as well. So dividends are given when a company is happy, when it's made extra money and it says, hey, look, I'm going to reward my shareholders and I'm going to give them some of the money that the company has made. And usually you don't get a lot, right? But one thing you're going to note is when you're investing over time, and later on we're going to talk about the difference between trading and investing, because there is a really big difference. But when you're investing over time, you're going to see a lot of people make specific portfolios just for their dividends because they want passive income of some sort. Again, like I did mention, dividends are usually paid in regular installment rates. So, you will have passive income. It's not just a one and done deal, right? Yeah, and again, hybrid securities have traits of both debt and equity securities. And I'll just draw with them. Do we have a smartboard marker? Okay. Perfect. Thank you. It's like, oh, I think so. It should be annotated. Yeah, there we go. So if I'm going to go back to what I was talking about right here, where if a company were to sell itself or go liquid for various reasons, debt security holders will have a higher claim to assets than equity security holders. I'm going to break that down and let you know what I mean. So let's go into a page where I have more room. This is fine. So if I'm to draw a line where I'm assuming as things go to the top, you get more important. Debt securities holders would be at the top. Hybrid security holders would be in the middle. And equity security holders would be in the top. I honestly find it kind of ironic that the literal owners of the company, i.e. people who have invested stock within the company, kind of get last dibs when that company may fail or go liquid. It's those debt security holders that get those first claim to assets, meaning they're going to get paid first, essentially, if a company fails, then hybrid, then equity. And again, as we go up, that's the order of importance. So that's not really particularly important for what we're going to talk about in the future, but just if you're into individual investing, this may be something that you want to consider, especially when you look into the risk of investing within a company, what security you're going to invest in with them. All right. Thank you so much, Mr. Colquitt. Sure. All right, but that's it for securities. Who had corporate structure? Perfect, I'm gonna get to cover it with you guys too. Okay, so this is important because this is what we're gonna reference whenever we have an IBC social of some sort. So it's important to understand where your investment banker lies, right? Are you meeting the CEO of a company, or are you meeting someone that's just fresh out of undergrad and is working? Because they obviously have different experiences and perspectives to tell you. One thing for certain I can tell you is that if you're straight out of undergrad and you're working in investment banking as an analyst right over here, you're probably not gonna love your life as much as a managing director would, simply because of the amount of time that you're attributing to your job. That's all right. But let's just start right over here. So straight out of undergrad, if you wanted to go into investment banking, and I'm gonna post the salary chart next meeting in 1.3 because we're going to talk about a bit more technicalities. It's important that you note that investment bankers immediately out of undergrad get paid more than you're already within like the top 90 or 80% of earners within America. So it's pretty insane, right? Straight out of undergrad, you're probably making $100,000 base, and then your bonus could be like 30,000. So that's analyst right over here. So yeah, I'll just quote some numbers. But students that recently graduated, it's a 2 to 3 year program. That's important to note because I teach investment banking as it's such a good platform to the buy side, which is 10 times more lucrative. And we're going to watch a video on that once again, just so that you can remember what it is we talked about last meeting, since, again, it's so important. But analysts are doing a lot of the work appropriated to them by higher-ups, and they're not really responsible for managing relationships with clientele. Again, investment bankers are selling a lot of the time. They're working with clientele, and analysts, unfortunately, aren't going to get into the middle of that action just yet. So then we have associates, and you can become an associate either by, well, graduating through that 2 to 3 year analyst program, or finishing up your MBA and just heading straight to an associate. And that's a 3 year program. Next next meeting during IBC Social, we're going to talk with the third-year associate. But you're doing a lot of what analysts are doing, except you're also managing them. And then you're getting ready for that VP role, which is more seniorly. And it's when you get to VP and third-year associate that you're actually going to start managing relationships a little bit more. And you're going to be talking a lot more with clientele. So that's the vice president right over here. You're out with that nitty-gritty and in with the coordination, managing, and also managing both your associates and analysts and client relationships. And then pitch books are essentially like brochures regarding companies. So when an investment banker goes to a group of investors within a meeting like this one, and he says, hey, look, I'm selling this company's stock because I want to raise money for this company, XYZ, that information is going to be in their pitch book. That's the brochure they're giving to these investors. And that's pretty intuitive. Then you have senior vice president, which is finding new business, traveling quite a bit, and then managing director, which is the last portion of this stage. And if I'm to give you around an estimate, it might take 12 to 15 years to reach this portion right over here, managing director. If I'm to quote some numbers, this may not be entirely accurate because I can't totally remember, but associates will probably make 170,000 base, and then with a bonus, maybe around like 230,000. Vice president, you're gonna make like maybe 250,000 base, and then it can go all the way up to 300 to 400,000. Senior vice president, probably all the way up to 700,000 a year. And then managing director, that could be 1 million a year, 2 million a year. At that point, you're the highest within the company. You're responsible for that investment bank making money. So the more deals you put on, right, likely the more you can make. Yeah, what's up? Don't worry about it. It's fine. Investment banking is more important. Okay, so we're going to watch this quick little video, and it basically summarizes a lot of... Let me actually turn on Do Not Disturb. Thank you. I'm going to start doing that. That's a good idea. Unfortunately. Oh, shoot. I think we still have to work out that sound thing. Okay, that's fine. You'll probably be able to hear it from here. I'll move this all the way up. And then I'll turn on captions as well. But this details the buy and the sell side. Remember, the buy and the sell side are kind of the two divisions of finance I'm going to be talking about a lot. And in my opinion, certain jobs on the buy side, which is why I teach investment banking, are quite a bit more lucrative than investment banking itself. And you already saw that investment banker salaries are insane. So if I'm saying that buy side salaries are even more lucrative, then you can only imagine how much bigger they get. And I'll probably go through some numbers with you. But again, I'm not teaching this just so that you're greedy and because you're money hungry. I teach investment banking because I'm genuinely passionate about it. Being the facilitator to capitalism, allowing companies to, well, make those ideas a reality. So let's just get straight into that.
Large financial institution.
Oh my God, bruh.
In a nutshell, underwriting is a service usually provided by a large financial institution that involves...
That is not right. Give me one moment. I can't use a computer. Yeah, the lag is crazy. I might have to go to a new Chrome profile. Are you serious? Okay, whatever. It's fine. This is AP Physics. This is the video I wanted to show you guys.
Buy side versus sell.
And there are no captions, so you'll just have to make sure that you pay attention. And we're going to start it.
Sell side. What's the difference between the buy side and the sell side? Well, if you look at this diagram of how the capital markets work,
hopefully you guys can hear that.
Corporations on the left, which need to raise money by issuing shares. These investors on the right represent the buy side. They are the ones that have the money and are going to make the investment into the corporation. Then in the center, we have the sell side, which represents the banks or the firms that have relationships between the corporations on the left and the investors on the right. And so the sell side facilitates the issuance of shares or bonds in exchange for capital back to the corporation. So in simplest terms, the buy side is investors and the sell side is banks or advisors. Now let's take a closer look at the sell side. It mostly consists of banks and advisory firms with careers like investment banking, equity research, and other areas that are advising on the issuance of shares. Let's look at an example. A company needs to raise money to build a new factory. So they use an investment banker to help them issue issue some shares. The banks
Securities we
prepare
just talked
marketing
about.
materials and build financial models. They can go out to investors with these marketing materials and hopefully raise the money. And this is where the buy side comes in. Then on the buy side, you have portfolio managers and asset managers that are looking to buy securities on behalf of their clients. They may invest in common shares, preferred shares, bonds, derivatives, and other securities. And to continue the example, an asset management firm that runs a fund looking to invest in manufacturing companies. The portfolio manager of that asset management firm is doing research on the companies in that industry and is then presented with an opportunity from the bank to buy shares of the new issue. The portfolio manager decides to buy those shares, which flows the money from the buy side through the sell side advisors over to the corporation. Let's look at the role of the sell side and the buy side. Let's look at how each of them operate their business. The sell side advises corporations on major transactions, such as capital raising, mergers and acquisitions, and similar transactions. Their goal is to win new business and maintain relationships. They also help create liquidity for listed securities by facilitating trading. They also provide equity research coverage for listed companies. They perform a lot of financial modeling and valuation, as well as a lot of relationship management. Then over on the buy side, we have the firms that are managing a client's money. They make investment decisions such as to buy, hold, or sell securities. They're interested in earning high risk-adjusted returns on their investments. They perform their own research and their own analysis. They also perform financial modeling and valuation. And their goal is to grow their assets under management and earn a combination of management fees and actual growth in assets under management. In terms of careers, on the sell side, the main jobs are highlighted in the top left section of this diagram, where you can clearly see investment banking, equity research, sales and trading, and then commercial and corporate banking as the most common jobs that are available on the sell side. The skills that you need to excel on the sell side initially include very analytical and research-oriented skills, such as doing industry research, building financial models, working in Excel, creating PowerPoint and pitch book presentations, but then over time, moving into a more relationship-oriented role that includes winning new business and closing deals with clients.
So that's kind of what I broke down.
Professionals that are on the sell side often work for performance bonuses based on the amount of business that they bring in and that the firm does. Now let's compare that to the buy side. The main jobs on the buy side are represented in the top right here. They include private equity and venture capital, portfolio management and wealth management, and hedge funds. The skills that are required on the buy side include initially some of the similar skills as the sell side, such as industry research, financial modeling, and Excel, as well as report generation and capital raising in terms of getting new assets under management. Broadly speaking, though, the sell side is more sales-oriented and the buy side is more research-oriented. Typically, professionals on the buy side are hired from the sell side, so there's often more experience required to be on the buy side.
And I mean, I just wanted to stop it there because I mean the rest is kind of general. But like he did say, a lot of careers on the buy side recruit people that are on the sell side, which is why I teach investment banking. Honestly, I find portfolio management to be a bit more interesting than investment banking. I really like looking at individual securities or investments and analyzing why this may be a better option. But again, if I want to go to those higher class buy-side jobs like private equity, venture capital, or working in a hedge fund, that usually requires some kind of analyst experience at an investment banking firm. That's why I teach it, just because it's going to help you transition into those more lucrative or other interesting careers. However, if you're solely interested on asset management, I.E., stocks, bonds, so on and so forth, then you might just straight out of undergrad want to go into portfolio management with a mutual fund of some sort. But that was that video. Again, there's the buy side and the sell side. Buy side is advising people regarding what investments they should take. Sell side is all about, well, selling those investments that the buy side will eventually buy. They're all connected. It's two divisions and they're all connected. Or it's one division that divides them into two and they're both connected. My computer doesn't really work that well, sorry. I'm just gonna go back here. There we go. All right.
In a nutshell, underwriting is...
We're going to talk about underwriting later. So sell side versus buy side. Basically what we covered. The only new addition of this portion is that the sell side and buy side can also be located somewhat within an investment bank. Now, I know that's kind of confusing, but remember, I said investment banks are like individuals. They're unique identities, like each and every one of you. meaning that sometimes an investment bank, just to make more money, because again, they're financial behemoths, they're also trying to make more money, will offer some advisory roles regarding, hey, you can buy this stock or this stock as well to individual clients or to companies. And that's also where a conflict of interest can come in, right? Because like I did talk about, investment banks will sometimes help IPO, initial public offerings. We're going to talk about that in chapter 2 and 3, or unit 2 and 3. They'll sometimes help IPO certain companies. And then at the same time, they may say, hey, look, we want you to buy shares of the company that we just IPO'd. Well, how does that work? Usually there are a lot of regulations within investment banks that don't allow that to happen because, again, it's illegal and you can go to jail for it. So that was that. Who is covering bank structure? Let's go, William.
All right, so there are 3 sections of an investment bank. All right, there's the front office. This is the part that sells the investments. It also does what Ion was just talking about, where they contact potential buyers, looking to do deals like after they IPO, or they do mergers and acquisitions. There's the middle office that's in charge of creating the new securities, and it coordinates with the front office, which is very important. And they also manage the risk and calculate the profit and loss. And the back office is just kind of like the base for everything. It maintains all the systems that allow the investment banks to complete their functions.
Awesome. Thank you, William. Give him a round of applause. That was awesome. All right, so I'm just going to elaborate on some of the bolded terms here. Whenever you see bolded terms or a number by something, that usually means that I don't expect you to know it. So I'm going to elaborate on it. So when we come to trading, does anyone know what proprietary trading is? So proprietary trading, kind of like if you open a business of your own, what do you call it? You're called, well, either an entrepreneur or a proprietor. A proprietor is the more specific term because, well, you opened up that business on your own, not with the help of anyone else, or at least anyone else in that CEO position that you've now assumed. So proprietary trading is similar in that it's a company trading so that it makes money on its own, with its own money. It's a company that trades with its own money. By trading, I mean trading stocks, trading bonds, so on and so forth. So the front office used to conduct trading with investment banks, proprietary trading specifically. Unfortunately, because of how risky proprietary trading may be, that was kind of outlawed by the Volcker rule. So that's not really a thing anymore. But we're going to talk all about the types of trading that investment banks do, funny, in unit 2. Thanks. All right. You start low so that you can go higher, right? So like if I tell terrible jokes, eventually, hopefully things will get better. I don't know. It's subjective. But that's really it for trading. But we're going to talk very deeply about trading in chapter 2. And that's where we come back onto that investment and trading cycle. It's pretty interesting how investment banks make money off of millisecond differences in stocks. So that's pretty cool. Also, all of the investment banking services that investment bankers do are in the front office. So whenever we talk about investment banking in chapter 2, in chapter 3, in chapter 4, in chapter 5, units, etc., we're talking about the front office for the most part. Middle office and back office, you're probably going to forget because I'm not really going to talk about it anymore. That in charge of creating new securities, investment banks are also responsible for making a lot of investments that you've seen in the past, such as credit default swaps, so on and so forth. Now, unfortunately, credit default swaps may be forgotten because they didn't really work out. Creating securities is a super risky game because why would you create a security? Why would I create an investment? Because I want people to invest in it, right? And not all securities are created equally. Not all of them are perfect. Not all of them are equitable. Funny, second way you can use that. But yeah, they have created securities in the past. They do still create securities, but us investment bankers don't really involve ourselves with that. We only involve ourselves with those bonds and those stocks, usually with the initial public offering. Who had larger bank structure? All right, perfect, Nicholas.
All right, y'all. So in the slide that you just covered, you got the bank structure. That's the bank structure of the individual banks, like how they operate. But this is the larger bank structure. So this is how the entirety of the market operates, like each category of banking. So you got 3 types of main banks. You got the bulge bracket. These are the super big ones. the most popular, everyone knows these. You got JP Morgan Chase, Goldman Sachs, Morgan Stanley, Credit Suisse. I don't know how that's pronounced. And then you got more. That's just like they have the most services. You know, they might deal with the largest IPOs. You got the most connections, basically. You know what I'm saying? Then you got boutique. That's the second highest, or second main highest. You got a little smaller. You got Stifel, Baird, JMP. You got extra. They might have a little bit. They do have a little bit less services. You know, maybe like smaller stocks, bonds, stuff like that. Then you got regional banks. These are really only a part of like you got, you know, they're in Texas only. So you got the I think Aldi is only like in Texas or like in the South or something. It's like Aldi, right? It's not like Walmart where it's all around the country, you know. It's only regional. You got SunTrust, Wedbush Securities, Piper Jaffray, and that's just in Texas. Then you got other ones in like a whole bunch of places, you know. These are just like, you got a couple services, you know. They might trade stocks or something.
Perfect. Thank you, Nicholas. So I'm just going to break this down like really quick because there's some more things I want you guys to know. But when we talk about bulge bracket banks, these are usually the most prestigious of banks. These are the Harvards, Yales, Princetons, etc. of banks, the hardest to get into. And these are usually the ones that only literally recruit from Harvard, Yale, Princeton, or people that have gotten their master's in business and administration, that extra 2-year program after undergrad that does require work experience prior to pursuing it. So if you don't go to the best undergrad school and you want to get into a prestigious bulge bracket, and I'm going to have my investment banker talk about that a little bit in 2 meetings, but yeah, if you don't go to the best undergrad, you may have to start considering a master's in business and administration as an option for these prestigious banks. Wait a second, JP Morgan Chase and Credit Suisse, you guys may have bank accounts there. Well, I'm not sure about Credit Suisse because that kind of got hostily acquired by HBS. And I'll talk about hostile acquisitions in chapter 4. That's going to be super interesting. We're going to talk about shark bait, shark blood. Yeah, really interesting jargon. But yeah, again, investment banks can be sections of actual banks and or traditional banks like JP Morgan and Chase. And bulge brackets, the biggest. Boutiques are smaller. Boutiques that are similar in prestige to things like Goldman Sachs or JP Morgan Chase would be your elite boutiques. So I think Lazard is one of them. And we're going to have someone from an elite boutique talk with you guys eventually. That should be really interesting. I think he's from Evercore. Evercore is one of them. And then you have your regional, which are the smallest. Usually bulge brackets will pay, no, actually, usually elite boutiques will pay the most. And then bulge brackets would be second. Why? Because a lot of bulge brackets will substitute prestige for the amount that they actually pay you. I know it's unfortunate, but you know, if you want that title, hey, I'm a Goldman Sachs banker, they're going to say, hey, you know what? You're a Goldman Sachs banker. If you want more money, go to someone else that doesn't have the title of Goldman Sachs. It's the way the world works, unfortunately. So this is just a graphic that helps better break it down with some more banks on here. Also, you're going to notice the term middle market. That's kind of like with boutiques right over here. They're not as big as bulge brackets. They're not like elite boutiques. They're kind of in the middle. Don't worry too much about them. But bulge brackets, biggest, usually the most prestige. And then second in prestige would be, you know, those elite boutiques. But middle market and elite boutiques are of kind of similar size. Usually when an investment bank gets smaller, its range of services will also get smaller. So it might only do a particular set of things. And then when we have to regional and industry, these are the smallest, limited to a region and very limited in their services. Like on the previous slide where it did mention some elite boutiques may just restrain themselves to underwriting services. I love underwriting. I know it's kind of weird, but I'm going to talk a lot about underwriting later on. I'm going to draw out a diagram to explain underwriting. And I just have so much about underwriting I want to tell you guys. And that's really in relation to the IPO, the initial public offering, aka the reason why you can buy stocks and bonds on the New York Stock Exchange, NASDAQ, so on and so forth. So that's it for today's meeting. Unfortunately, for some reason, this QR code is not working. I guess the service we used has discontinued this QR code, so I'll make sure to re-upload a new one for the next meeting. But if you want to go onto our link tree, just go onto the attendance thing that you opened up on your doc, and the link tree is right over there. So you can look at the Instagram posts, etc. We have a lot of links on there. And then these are today's credits. Does anyone have any questions? And if you don't want to, you know, shout them out publicly, you can always come up to me after the meeting. Well then, if not,